Let me ask you something. If I said, how long will it take for your money to double? What would you guess? 10 years? 20? A lifetime? Most people shrug and say something vague like, well, it depends. And they're not wrong, it does depend. But here's the catch. Once you understand how doubling actually works, you stop seeing money as a slow, boring grind and start seeing it as something alive, something that grows faster the more attention you give it. We're talking about the Rule of 72, one of the simplest, most powerful financial shortcuts ever discovered. But before we get there, let's slow down for a second. When you put money in a savings account, it's like planting a seed in poor soil. It'll grow, barely, maybe a tiny sprout after years. But put that same seed in rich soil, give it sunlight and water, suddenly it shoots up like a tree. That's the difference between parking your money and investing it. Now, let's get to the good part.
The Rule of 72, your shortcut to doubling.
Here's how the math works. Take the number 72 and divide it by your annual return. The answer tells you roughly how many years it'll take to double your money. So if your money earns 8% a year, 72 divided by 8 equals 9. That means your money doubles every 9 years. If your return is 4%, it takes 18 years. If it's 12%, you're looking at just 6 years. Simple, right? But the impact is anything but simple. Let's say you invest $10,000. At 8% return, in 9 years, it becomes $20,000. Then another 9 years, $40,000. Then $80,000. Then $160,000. That's 4 doublings from $10,000 to $160,000 in under 40 years. And that's without adding a single extra dollar. That's the quiet superpower of compounding. The slow lane, savings accounts. Most people park their money in a savings account because it feels safe. No swings, no stress, no red numbers. But here's the truth. Safety comes with a hidden cost, time. Let's do the math. The average savings account in the US earns about 3% interest right now. Federal Reserve data 2024. So 72 divided by 3 equals 24. That means your money doubles every 24 years. 24 years. That's nearly a quarter of a human lifetime. Sure, it's stable, but inflation eats a silent chunk every single year. According to the US Bureau of Labor Statistics, inflation has hovered between 3 to 4% annually since 2021. So if your money grows 3% and prices rise 3%, your real growth is basically zero. Your account balance may look bigger, but your purchasing power hasn't moved an inch. You worked hard, saved diligently, yet the system quietly drains your effort. The fast lane, the stock market. Now let's shift gears. Historically, the S&P 500, that's the index of the 500 biggest US companies, has returned about 10% per year on average, according to Standard & Poor's data. Let's apply the rule of 72 again. 72 divided by 10 equals 7.2 years. That means your money doubles roughly every 7 years. That's faster than a car loan, or even the average time people stay in a job. And the best part? The growth comes from 2 sources. Price appreciation, companies becoming more valuable. Dividends, the little bonuses you get just for holding their stocks. But remember, this is not a smooth ride. The market dips, sometimes hard. In 2008, it dropped nearly 50%. In 2020, during the pandemic, it fell 34% in a month. But every single time, it eventually recovered and reached new highs. Now, what if you go beyond the index? Maybe you pick individual stocks, ETFs, or even sectors like tech or energy. Let's say you manage a 12% average return. That means your money doubles every 6 years. That's not a fantasy. Over the last decade, investors in funds like the NASDAQ 100 saw annualized returns near that mark. But let's be real, this also comes with bigger mood swings. One year, you might gain 30%. Another year, lose 15%. The trick is not in timing, but time. Staying invested long enough for compounding to do its work. Here's the wild part. At 12% annual growth, in just 30 years, your $10,000 turns into over $300,000. That's 30x your starting point. That's why experienced investors say, don't chase quick wins, chase compounding. Real estate, the leverage game. Some people look beyond stocks and head straight for real estate. And here's why it's so seductive. You can use other people's money to make your own money grow. Say you buy a $200,000 house with a $40,000 down payment. If that property appreciates by just 5% a year, your $200,000 home becomes $210,000, a $10,000 gain. On your $40,000 down payment, that's a 25% return. That's leverage, and it's one of the biggest reasons people build wealth through property. Of course, real estate has its own headaches: maintenance, tenants, loans, taxes. But when it works beautifully. A good real estate portfolio can generate 15 to 20% annual returns, which means your money could double in less than 5 years. The real difference. So why do some people get rich while others stay stuck? Because most people underestimate how fast small percentages add up. A 3% return barely moves the needle. A 10% return changes the game. Let's look at the numbers side by side. At 3%, double in 24 years. At 10%, double in 7 years. At 15%, double in 4.8 years. The difference between slow growth and exponential growth is literally decades of your life. And here's something even more surprising. Every time your money doubles, the next doubling happens faster in real dollar terms. Your first $10,000 doubling to $20,000 feels small, but the next doubling from $20,000 to $40,000 happens in the same amount of time, and that's $20,000 gained, not $10,000. The next doubling to $80,000, that's a $40,000 jump. Same years, bigger jumps. That's exponential growth in action, quiet, powerful, and accelerating behind the scenes. Why we struggle to see it. Our brains are wired to think in straight lines. We expect one step to equal one result, but compounding doesn't play by those rules. It's more like climbing a hill that slowly turns into a mountain. At first, you barely notice the incline, and then suddenly you're rocketing upward. Albert Einstein allegedly called compounding the eighth wonder of the world. Whether or not he said it, he was right about one thing. Most people never truly understand it. They stop too early, pull out too soon, or stay stuck in the slow lane because they don't see what's happening underneath. In the early years, compounding feels boring. In the later years, it feels unreal. The inflation trap. Now let's talk about the silent killer. Inflation. If inflation runs at 3% and your investment grows at 3%, you're just treading water. At 10%, you're outrunning it, and that difference determines whether you get ahead or just keep up. That's why real returns, meaning returns after inflation, matter way more than headline numbers. Because money that doesn't beat inflation isn't growing. It's quietly shrinking in what it can buy. So the question isn't just, how fast does my money double? It's also, what's it doubling against? Because if prices double while your money doubles, you haven't gained anything. Here's where we'll pause. By now, you've seen the math, the examples, the difference between slow and fast lanes. You know that compounding is real, that doubling is possible, not through luck, but through time, consistency, and smart risk. But we've only covered half the story. In part 2, we'll go deeper into how to accelerate these doublings, why most people accidentally slow theirs down, and the hidden shift that separates the financially free from the constantly struggling. Because doubling your money isn't just about math, it's about mindset. And once you see it, you can't unsee it. The psychology of doubling and how to make it work for you. So, now that you know how money doubles, let's talk about why most people never let it happen. Because here's the funny thing, the math is simple, but the behavior isn't. The numbers don't lie, yet emotions, impatience, and fear often win. Let's face it, watching your money grow is easy when the graph goes up, but the moment it dips, people panic. They sell too early, they wait for the right time, or they get distracted by the next shiny thing. Crypto, meme stocks, gold, whatever's trending. The result? They cut the compounding engine off right when it's about to take off. The real secret behind compounding. The truth is, compounding doesn't reward intelligence. It rewards patience. Think about Warren Buffett, one of the richest people alive. Most of his wealth didn't come from finding the next big thing. It came from letting his investments grow for decades. According to a Forbes analysis, Buffett made over 90% of his wealth after his 50th birthday. That's compounding at work, slow, quiet, and unstoppable. Buffett once said, "You can't produce a baby in 1 month by getting 9 women pregnant." That's compounding in a nutshell. You can't rush it, but you can protect it. How most people accidentally slow it down. Here's the pattern that keeps people stuck. They start investing, see a small gain, get bored, cash out, start over, repeat. Every time they reset their doubling clock. It's like pulling a cake out of the oven every 5 minutes to see if it's done. It never bakes properly. And this doesn't just happen with beginners. A 2022 study by Dalbar found that the average investor underperforms the S&P 500 by about 4 to 5% per year, simply because they jump in and out at the wrong times. That 4% difference, it can literally halve your wealth over a lifetime. The critical mass moment. Here's the beautiful part though. If you stay consistent long enough, you eventually hit a tipping point. Let's call it critical mass. It's the stage where your money starts growing faster than you can possibly add to it. At first, your savings matter more than your returns. But once the snowball gets big enough, returns start to matter more than your savings. Say you've got $100,000 invested. A 10% return earns $10,000 a year. That's the same as saving $833 every month without lifting a finger. Now bump that up to $500,000. That's $50,000 a year in growth. At $1 million, it's $100,000 a year purely from compounding. At that point, your money has basically become an employee that never sleeps, never complains, and gets a raise every year. Why doubling feels unreal and why it's real anyway. Let's do a little thought experiment. Start with $10,000. If you double it once, you've got $20,000. Twice, $40,000. 3 times, $80,000. 4 times, $160,000. 5 times, $320,000. 6 times, $640,000. 7 times, $1.28 million. 7 doublings. That's it. That's millionaire territory. And yet, most people never make it past the second or third doubling. Why? Because they think in linear time. We humans are bad at understanding exponential growth. We expect progress to feel gradual, like climbing stairs. But compounding is like an escalator that starts slow and suddenly takes off. That's why the first few years feel painfully slow. You're in the flat part of the curve, but then it explodes. If you stay consistent long enough, it feels like magic, but it's just math finally revealing its full power. The magic of contributions. Now, let's add one more variable, you. Because your regular contributions can turn modest returns into massive growth. Let's say you invest $10,000 and never touch it again. At 10% a year, it becomes about $20,000 in 7 years. But if you keep adding $500 every month, that's $6,000 a year. After 7 years, you'd have roughly $80,000. That's not a typo. And if you start with $100,000 and keep adding $500 monthly, you're looking at about $250,000 in that same period. This is why consistency beats brilliance. The investor who quietly adds money every month will always outperform the one who chases the next hot stock. Doubling through choices, not just returns. Here's a fresh perspective. Doubling your money isn't always about waiting for an investment to grow. Sometimes it's about freeing up money that can start growing in the first place. If you refinance a loan and save $300 a month, that's $3,600 a year that can go straight into your investment account. Cut a few unnecessary expenses, that's like doubling your contributions without earning an extra penny. You can double through smarter decisions, not just higher returns. That's something most people overlook. The silent losers of wealth. Now, here's a hard truth. If your wealth is trapped in things that don't grow, you're silently losing money every day. Cars, electronics, and furniture, they depreciate the moment you buy them. In fact, according to Kelley Blue Book, the average new car loses 20% of its value in the first year, and about 60% within 5 years. If 80% of your net worth is tied up in stuff that goes down in value, your compounding engine is running on fumes. But if 80–90% of your money is in growth-oriented assets like stocks, ETFs, or real estate, then every doubling counts. Because those assets don't just sit there, they grow on their own. Doubling beyond money. And here's where it gets deep. This principle doesn't stop with dollars. Knowledge doubles, skills double, relationships double. If you learn one new skill every year, and each skill multiplies your income potential, that's another form of compounding. If you build a network of people who open doors for new opportunities, that's doubling too. Money is just one kind of asset. Your mind and your habits are the others. When you combine them, growth becomes inevitable. The emotional side of compounding. Let's be honest, watching a graph move upward over decades sounds boring. But the emotional reward comes later. The calm of knowing you don't have to panic over bills. The freedom of choosing work you actually enjoy. The quiet power of realizing your money grows while you sleep. That's not luck. That's compounding mixed with consistency. The best investors in the world aren't obsessed with predictions. They're obsessed with time in the market. As a study from JP Morgan found, missing just the 10 best market days in a 20-year period can cut your returns by half. So instead of trying to time the market, they just stay in it. How to build your own doubling system. Here's a simple approach that works in any economy. First, automate it. Set up automatic investments, whether it's into an index fund, a retirement account, or a diversified portfolio. Take the emotion out of it. Second, focus on consistency, not perfection. You'll never buy the exact bottom or sell the exact top, and that's okay. Third, reinvest your gains. Dividends, interest, rent, feed it back into the system. That's what fuels the next doubling. And finally, give it time. Remember, the first doubling feels small. The next one feels bigger. But after the fourth or fifth, that's when you start seeing wealth that looks unreal. The final shift, from saver to investor. Here's the mindset change that separates the average from the wealthy. Savers look for safety, investors look for growth. Savers worry about losing money. Investors focus on not missing opportunities. Of course, you need an emergency fund, that's common sense. But once that's set, every dollar sitting idle is a dollar not working for you. Think of your money like employees. Do you want them sitting in the break room doing nothing, or out there earning more employees for your team? That's the energy shift. That's how wealth accelerates. So here's what we've learned. Your money can double faster than you think if you give it the right environment. At 3%, it's slow. At 10%, it's powerful. At 15%, it's life-changing. But the real trick isn't chasing higher returns. It's staying consistent long enough to let the math do its thing. When you think in decades instead of months, You realize you don't need to outsmart anyone. You just need to outlast them. And remember, compounding doesn't just build wealth, it builds freedom. Because one day, you'll look back and realize your money doubled several times while you were busy living your life. That's the quiet power of patience. That's the exponential force working behind every great fortune. And once you understand it, you'll never see money the same way again.